What if the real danger in a market crash isn't what you see on the charts, but what's happening quietly behind them? Most people stare at red candles, support levels, and technical indicators believing the truth is visible on the screen. It isn't. Market crashes are shaped less by charts and more by hidden mechanics, emotions, and decisions that never appear in public data. By the time the charts confirm trouble, the damage is already underway beneath the surface. In this video, we're going to look past price action and into the forces most investors never hear about. These are the realities that explain why crashes feel sudden, why rebounds fail, and why so many people are caught unprepared. Once you understand what's happening behind the charts, market behavior starts making unsettling sense. Charts only show the outcome, not the cause. Charts are the final result of decisions already made, not the process that created them. By the time prices fall sharply, institutions, funds, and large traders have often adjusted positions long before. What retail investors see as a sudden crash is usually the visible end of quiet repositioning. Risk is reduced discreetly, liquidity thins, and confidence erodes silently. Charts reflect this only after the damage is done. This is why relying solely on technical signals leaves people late to every major move. Markets don't collapse because a line breaks. They break because trust and liquidity weaken first. Understanding this explains why charts feel misleading during crashes. They don't lie, but they speak too late to protect unprepared investors. Liquidity is disappearing long before prices fall. One of the least discussed drivers of market crashes is declining liquidity. Before prices drop aggressively, liquidity providers quietly step back. Order books look normal, but depth is thinner than it appears. When selling pressure increases, there isn't enough support to absorb it smoothly. That's when sharp moves begin. Charts don't show missing liquidity. They only show its absence after volatility explodes. This is why crashes feel sudden and extreme. Once liquidity leaves, even small trades cause big price swings. Many investors confuse this with panic selling, but the real issue is structural. Markets fall fast, not because everyone sells at once, but because there's no one left willing to buy at stable prices. Confidence collapses. Before price does market crashes begin psychologically, not technically. Confidence breaks quietly as uncertainty spreads among large players. When trust weakens, participation declines. Fewer buyers step in, fewer risks are taken, and recovery attempts fail quickly. Charts only reveal this once prices start falling, but the emotional shift happens earlier. Traders become defensive without announcing it. Institutions reduce exposure without headlines. This creates fragile conditions where any pressure causes outsized reactions. Confidence is invisible, yet it's one of the strongest forces in markets. Once damaged, it doesn't return easily. That's why rebounds after crashes often feel weak and temporary. Charts show volatility, but confidence determines whether volatility leads to recovery or deeper decline. Leverage is the silent accelerator. Behind most market crashes lies excessive leverage. Borrowed positions amplify movements and distort stability. When prices move against leveraged traders, forced selling begins. These liquidations aren't strategic, they're automatic. Charts don't show leverage levels directly, but crashes reveal them brutally. What looks like panic is often mechanical selling triggered by margin rules. Worse, the first wave of liquidations rarely clears all leverage. It exposes how fragile the system actually is. As prices continue to fluctuate, more forced selling follows. This creates cascading declines that charts alone can't predict. Understanding leverage explains why markets fall faster than they rise, and why crashes accelerate even when news doesn't seem proportionally bad. Institutions react quietly, not dramatically. Retail investors expect dramatic exits during crashes, but institutions behave very differently. They don't panic sell. They reduce exposure gradually and silently. This controlled retreat weakens market structure without obvious signals. Prices may drift lower instead of collapsing immediately, creating false comfort. Charts during this phase often look like consolidation. In reality, support is eroding. By the time selling becomes visible, much of the institutional protection is already gone. This is why crashes often feel inevitable after they start. The selling you see is rarely the cause, it's the confirmation. Institutions prioritize survival over performance, and their quiet decisions shape the environment long before charts reflect the consequences. Artificial intelligence is reacting faster than humans. Artificial intelligence-driven systems adjust risk automatically when instability rises. They don't wait for confirmation or emotional reassurance. When volatility increases, correlations tighten, or liquidity weakens, these systems reduce exposure instantly. Charts don't reflect this behavior directly, but its impact is significant. As artificial intelligence models step back, momentum fades and recoveries struggle. This creates an imbalance between human optimism and automated caution. While some investors buy dips emotionally, automated systems defend capital. Over time, this divergence drains strength from the market. Artificial intelligence doesn't predict crashes. It reacts to stress faster than people can. That speed quietly reshapes markets in ways charts don't fully explain. Correlations break down at the worst time. During market crashes, assets that usually move independently begin falling together. Correlation spikes catch investors off guard. Diversification stops working when fear dominates decision-making. This isn't visible on individual charts until losses pile up across portfolios. The reason is behavioral, not mathematical. When risk rises, participants sell what they can, not what they want. This synchronized behavior intensifies declines. Charts show separate assets dropping, but they don't explain why diversification failed. Understanding correlation breakdowns reveals why crashes feel so overwhelming. Everything appears broken at once because market participants are responding to the same pressure, preserving liquidity and reducing uncertainty at any cost. Recovery signals are often misleading. Sharp bounces during crashes tempt investors into believing the worst is over. Charts flash green, indicators reset, and optimism returns quickly. Historically, these rebounds are driven by short covering and temporary relief, not renewed confidence. Without liquidity and trust, recoveries lack substance. Charts show price movement, not commitment. When buying pressure fades, prices roll over again. This traps those who re-enter too early. Real recoveries are slow, uncomfortable, and boring. They don't offer dramatic candles. Understanding this helps explain why chasing rebounds after crashes often leads to more losses. Charts show opportunity, but structure determines sustainability. Time does more damage than the initial drop. The most dangerous phase of a market crash often comes after the big move. Extended uncertainty wears people down. Sideways movement, failed rallies, and slow declines drain capital and confidence. Charts look less dramatic, so risk feels lower. It isn't. Prolonged instability increases mistakes, overtrading, and emotional decisions. This is where many accounts quietly bleed out. Time magnifies errors when exposure remains high. Charts may not look terrifying, but the environment becomes toxic for decision-making. Understanding this explains why experienced participants step aside during uncertain periods. Survival isn't about avoiding one crash. It's about enduring what comes after. Media explains price, not structure. Most commentary during crashes focuses on surface explanations, news events, economic data, or sentiment shifts. These narratives rarely address structural damage beneath the market. Liquidity gaps, leverage exposure, and risk models don't make headlines, but they shape outcomes. Charts paired with headlines create simplified stories that miss the real drivers. This leaves investors reacting instead of understanding. Market crashes aren't caused by one event, they're revealed by it. When structure is weak, any shock becomes dangerous. Recognizing this difference helps investors stop chasing explanations and start respecting conditions. Charts tell you what happened, structure tells you what can happen next. Retail participation often peaks at the worst time. Ironically, retail activity often increases after crashes begin. Lower prices feel attractive, and narratives of opportunity spread quickly. Charts encourage dip buying behavior. This participation provides temporary support but creates future selling pressure. When prices fail to recover, these positions add weight to further declines. This pattern repeats across market history. Retail optimism peaks when risk remains elevated. Charts don't show positioning quality, they only show activity. Understanding this explains why markets struggle to stabilize after crashes. Recovery requires strong, patient buyers, not hopeful ones. Without that foundation, price action remains fragile despite visible interest. The crash isn't the warning, it's the confirmation. By the time a market crash is obvious, the warning period is already over. The crash confirms problems that existed quietly for weeks or months. Charts make the risk visible, but they don't create it. This is why reacting late feels inevitable. The real signal was structural weakness, declining liquidity, rising leverage, and fading confidence. Once confirmed, damage control becomes the priority. Understanding this reframes crashes entirely. They aren't surprises, they're revelations. Those who learn to recognize conditions before price collapses gain a powerful advantage, the ability to step back before charts demand it. Market crashes feel chaotic on the surface, but beneath the charts, they follow clear and repeated patterns. Liquidity thins, confidence erodes, leverage accelerates damage, and structure breaks down before price ever tells the story. Once you understand these forces, crashes stop feeling random and start feeling recognizable. This isn't about predicting tops or bottoms, it's about reading conditions honestly. If this perspective helped you see the market more clearly, show your support by liking, sharing, and subscribing. Leave a comment with your thoughts or experiences. Your insight could help someone else avoid costly mistakes. Stay informed, stay disciplined, and stay ready, because understanding the market matters most when it stops making sense.